spend, and the biggest spend every single month, generally speaking, is going to be that housing expense. So we can eliminate that housing expense by doing the house hacking method. And the house hacking method is great because it is relatively cheap to get into. For instance, you can get into most house hacking situations with 3.5% down, as long as it's 4 units or less. And you'll be looking at an FHA mortgage situation. So you need to factor in the insurance premium in house hacking expense by doing the house hacking method. The house hacking method is great because it is relatively cheap to get into. For instance, you can get into most house hacking situations with 3.5% down, as long as it's 4 units or less. And you'll be looking at an FHA mortgage situation. So you need to factor in the insurance premiums into that monthly payment. But again, that goes to the whole living frugally thing. A lot of people say insurance premiums, those monthly insurance premiums, are bad. They're very bad. Avoid them at all costs. Put 20% down. And I say, as long as you factor it in and you're looking at it like a business, then it's fine. If your monthly income is covering those expenses, those operating expenses, then you're doing okay. You're running a good business. So kind of think about it like that next time that you are looking for a rental property or looking to move. And really the last great thing about house hacking is that it starts to get you into that investment mindset if you're not there already. And what I mean by that is you will start to look at all primary residences, real estate that you want to own or occupy. You're going to start looking at that with a business mind, with an investment mind. You're going to say, I want to move into this. This is a great property. The mortgage is $2,000 a month. Can I rent out the other rooms, or can I rent out the other units for more than $2,000 a month? And if not, if I can only rent it out for $1,600 a month, meaning my net payment is going to be $400 a month, is that more or less than what I'm paying today? And when you start to look at housing, especially as a business, as an investment, you are well on your way to building wealth. I wrote an article about house hacking on BiggerPockets, and I'll link to it in the show notes. But basically, it was comparing two people. It was comparing a person who is investment savvy and a person who is salary savvy. So the person who is salary savvy gets paid a high income, but they also spend a large amount of that income. And they're not necessarily generating equity with the money that they're spending. For instance, maybe they're renting. Maybe they're in a city where it's not affordable to buy, so they just continue renting to stay in the middle of the city, in the hot spots, and an easy commute to work. And there's definitely value there. I'm not saying that that's a bad choice. But at the same time, you might have somebody else who worked a full-time job for a couple of years, built up savings, was able to finance a 4-unit property or a 3-unit property or even a duplex on their W-2 income. And maybe they did it strategically so that the rents from the other units actually cover their mortgage expenses. Once they move in, rent all the units out, and they're cash flowing or breaking even, or maybe even a couple $100 net payment, it really changes your financial situation because that person can look at their income source, and say, does this really make sense for my long-term goals? Does this align with my values? Roughly 70% of employees are not satisfied at work. So a house hacking type situation gives you a lot of power. If you no longer have a huge living expense, you don't necessarily need the large amount of income to support you. And specifically in my BiggerPockets article, I had the salary savvy person generating, I think it was like $110,000 per year in salary, which is a great pay. I mean, a lot of people, when they hear 110K, kind of get a little jealous. Like, hey, I want to earn that much money. But at the same time, if you can't keep that money, then you're not really making $110,000 a year. That's what you're grossing, but you're not netting that. And that was the point that I was trying to illustrate with this article. It gives you the ability to, one, control your expenses, minimize your better way to put it. But two, it gives you the ability to control that income source. So if you're one of the people that really dislikes your job, house hacking is going to be the way to go. So figure out what type of property you can buy, whether it's single family or multifamily, and then figure out when you can buy it, how much money you need, and just do it. But I can't leave you with that because this is the Real Estate CPA podcast, not the House Hacking Financial Savvy podcast. While I'll talk about being financially savvy all day long, I also kind of want to rope in the tax side of things. So house hacking kind of causes an interesting situation. Basically, what's going to happen is you are living in a portion of the entire building, and your tax situation needs to reflect that fact. If you own a 4-unit property and you're living in one unit and renting out the other 3, theoretically, if we're going by units and not by square footage or bedrooms or whatever else you want to apply, you live in 25% of the building and you're renting out 75% of the building. From a tax perspective, 25% is going to be considered your personal residence. So that unit that you live in is your personal residence. The remaining 75% is going to be considered rental property or investment property. So when it comes down to tax time, you are going to report 75% of the expenses on Schedule E, on the investment side of things, not on Schedule A, which is where you're going to report the personal side of things. And splitting expenses can get very tricky. So, for instance, we might have insurance expense. Insurance expense for a primary residence is not deductible. But if you have an investment property where you are living in one unit and renting out the other 3, theoretically 75% of the insurance expense is now deductible. As an investment expense, where for instance, we might have insurance expense. Insurance expense for a primary residence is not deductible. But if you have an investment property where you are living in one unit and renting out the other 3, theoretically 75% of the insurance expense is now deductible as an investment expense rather than a primary residence expense. And the same goes for taxes and interest expenses. So taxes, generally you would allocate 100% to either the investment side or to Schedule A, the personal side. But if you're living in 25% insurance, 5% a primary residential side of things. And splitting expenses can get very tricky. So for instance, we might have insurance expense. Insurance expense for a primary residence is not deductible. But if you have an investment property where you are living in one unit and renting out the other 3, theoretically 75% of the insurance expense is now deductible as an investment expense rather than a primary residence expense. And the same goes for taxes and interest expenses. So taxes, generally you would allocate 100% to either the investment side or to Schedule A, the personal side. But if you're living in 25% of the unit, you actually have to split the taxes between the personal unit and the investment unit. And the same goes for interest expenses. You're going to split that interest expense between the personal and the investment side. And this could cause problems because if you don't have enough itemized deductions, you're going to take the standard deduction at the end of the year. And potentially what that means is that 25% of your taxes, 25% of your interest expenses, the amount that is allocated to personal use might not even be deductible. Now, you're still going to get your standard deduction, but what I'm saying is that you're not going to itemize deductions. So it does take a little bit of tax planning and a little bit of coordination to kind of figure out what the best route is to take in regards to these expenses that you're splitting between the investment side and the personal side. Another big factor is maintenance and repairs. So any sort of maintenance or repairs to common areas will be split between the investment side and the personal side. So again, that 25-75% split. But any repair made to your own unit, so like if you replace the floors in the unit that you're living in, that will not be deductible. That